So, as we get started, I want to make a clear statement that I am not an economist. I'm a pragmatic realist who actually gets paid to put things in application. And so the discussion that we'll have today, I want to make sure we're grounded in the perspective at which we look at it. A lot of what we talked about in the last hour and a half was about 23 and 24 very specifically, because a lot of people want to know what's going to happen, right? Who in the hell knows exactly what's going to happen? So let's not try to bait ourselves into that conversation. So if we raise up a level and we begin to talk about what's structurally changing within the markets that I play in, you can actually begin to plot a path over the next decade. That's what I'm going to try to convey to everyone in here today. A little bit about how Wabash is playing that, and how do we think it affects multiple aspects of each of your individual businesses, whether you're specifically supplying the truck, trailer, truck body, vocational markets, or you're here to learn more about decarbonization, what that means as a growth path that maybe you want to learn more about. So that's somewhat the intent of what we're going to talk about here. Now, but to specifically address some of the things, so this is where my group gets nervous because I go off script to what we're going to talk about, especially our IR guy who's sitting in the office, or sitting in the audience. So in the context of, is it a recession? Is it recession light? Whatever. Okay, here's what I would say. There are aspects of the economy, industry segments, that are going to be in full-fledged recession. There are absolutely going to be aspects of the economy that are going to be recession light or even in a mode of growth. Right? I think what we need to understand is how that plays out over time, over the next 2 years, if you're thinking about short-term decision making. But that is not the same as making long-term decisions in how you best serve customers, how you deploy capital, and how you invest in R&D. Completely two different things in how you look at it. There was a slide that went up relative to a model of how we should think about freight. I would argue it's missing something, and we'll talk about it. One of the things I feel like it's missing is that we're seeing a backwards integration of inefficiency inside of logistics that is not well understood, is not statistically modeled, because it's very hard to see, but we can feel it and we know it by talking to customers as to what they feel, what they're experiencing, and how they're managing their company and the problems that they need solved. Now, I want to, did I lose? There it is. That we also like to think of Jeff as our Kung Fu Panda. He is our Kung Fu Panda. And he is absolutely right. The idea of it'll be different this time is incredibly dangerous, right? To think about that as a manufacturer or someone that works within the economy. But it was also said, it's always different, which is absolutely true too. The art of it is figuring out on a short, medium, and long-term basis what aspects are changing that you can take advantage of to alter your strategy to benefit you and your customers. And we'll talk a little bit about that. That's the nuance of it. And a lot of what we talked about here was very broad-brushed, right? It was the broad economy. And now we want to narrow it down a little bit to how we think about it, okay? And I also think that the idea, I have looked at, that I fondly like to call them his scribble charts. I don't have a better word for it, sorry. Is that they do ring true, that we will move through that zone of caution as we go down this path. And absolutely, there is a litany of issues that can pop up that could exacerbate in that period. I don't really need to know what it is. I really don't care. I just need to know the risk exists in the context of how you deploy strategy, deploy capital, you deploy resources, and what you're managing for the long term, right? Because if not, you just confuse yourself as to how you should manage your business. Okay? So I wanted to say that to make sure that we're kind of grounded in how this discussion will go. I will try to spend or leave at least 10 minutes for questions. I'd like you all to do a better job than the last presentation of generating your questions as we go, right? So we can have a fruitful conversation. So we are a publicly traded company. That's our safe harbor statement. I've done my duty. Check. Moving on. Okay. So if you are not familiar with Wabash, and Kenny alluded to it, we rebranded. We dropped the national, it's just Wabash, as part of the overall strategic direction of the company and where we're moving. But today, we're about a $1.3 billion market cap company. We have roughly 6,900 employees in North America, 15 manufacturing locations. We were $2.5 billion of revenue in 2022, which is a record revenue year for Wabash. And an operating margin about 6.7%, which is in line with expectations that we gave as far back as 2019. And we're really in a great position to build off of that in 2023. So we have two operating segments specifically around transportation solutions and parts and services. Transportation solutions is where you will know most of our, call it products, our dry vans, refrigerated vans, platforms, tanks, the traditional core products that we have. But we are very specifically focusing on our recurrent revenue through our parts and service segment, which we believe is an area of impending growth, not only for Wabash, but we'll also talk about this in the context of non-traditional services that will specifically target a growing level of inefficiency that fleets need the problem solved for, right? And it really talks about why Wabash thinks about itself, specifically in the future, as being less about just transportation and more about transportation, logistics, and distribution, and how do you solve problems that actually span across all three of those segments. So with that, so when we think about the market, we really want to think about cyclical and structural tailwinds. And when we think about structural tailwinds, these are not tailwinds that exist for a year or two, but are generational, are decade-long level structural trends that we can build a strategy around and a future growth path. So, but you can't take away from what's actually happening in the near term. And the near term is we're sitting with, on the trailer side of the market, at least, and I put asterisks beside this, at least 150,000 unit underbuy in the last 2.5 to 3 years. That is a near-term structural issue that will alleviate itself over time, right? On the truck body side, we're staring at least 100,000 unit structural deficit in the ability to produce relative to demand. And arguably, it's significantly larger than that, but that's a little bit more harder to calculate. So we see that as something that buffers at least 22, 23, and arguably 25, because one of the issues is that we are still structurally encumbered by supply chain across the entire industry, which will prevent us or the industry from really adequately supplying based off of a range of demand conditions, even factoring in a modest recession, is the way that we look at it. So, but I think what's most important in what we look at are these structural factors. A lot of them were talked about in the panel, but again, thinking about it in a more narrow time frame, now let's blow it up and think about it in a 10-year time frame. From a geopolitical standpoint, I agree with the statement that was made that we're starting to see access generation around the world. That is not a trend that's going to reverse itself quickly in any way, shape, or form. The events that created it were structural in nature, right? Creating that geopolitical instability that now things are in motion that can't be taken back, right? That will literally be 30 years in the making. And that really does, we have to really understand what does that do to the infrastructure of manufacturing. There's so many things that were talked about. Chips, the broader context of nearshoring, you can keep going on. That's a topic in itself. But we have to understand what's causing it. And I can think about it going all the way back to Trump tariffs, which was a seismic event when that was launched. And all of a sudden, your investment decisions to manufacture outside the United States took a dramatic hard left that you could not take back. They haven't gone away, and it started there. And it's just continued to proliferate over time. The nearshoring is real. And we're talking to the National Association of Manufacturing, and one of the reasons we haven't seen more of it is that we're still constrained by environmental permits, port activity, labor. As those things begin, there's a pent-up demand for flow of that nearshoring that will begin to burst, or the dam will burst, and we'll see that coming in the next 36 months. And that will have very structural change elements to the overall logistics models across the country that will stress already growing levels of inefficiency and strain. That needs to be factored in, and I'm not sure we see that because that's really looking forward and really understand forward constraints, not rearward past models. And we need to think about that. E-commerce growth. Now, I think it was Jeff that talked about it. When we were in the 2020-21 timeframe, we saw the rate of change of e-commerce just dramatically take a step function increase. We've seen that level off. But the inefficiency that is now backwards integrated through the entire logistics model has stuck. We still have the relative forward change, maybe a lower acceleration, but we're still increasing the net impact. So we think first, second derivative. So first derivative, absolute, second derivative, rate of change. The absolute is still growing, right? And that is an exponential impact in inefficiency inside the overall logistics markets. And that is not necessarily being taken into account when we look at models today. And that's something, if you're in the audience, you should be thinking about as you run your business. Sustainability, we have a whole topic around decarbonization today. That's one aspect of it. And one of the things we'll talk about is a very narrowly construed way of thinking about sustainability. We're going to try to blow that up a little bit. But sustainability, from a market perspective, maybe it doesn't exactly change absolute market, but it does change intricacies inside the market that companies can make strategic choices about and how they want to tackle that. Autonomous isn't today, but it may be tomorrow, and that creates further logistics model change and asset need change over time. The macro labor side of it, again, not an economist, I'm a realist, and as a realist, I look at a 10-year period of relative labor inflation that's structurally embedded now. I don't see that changing. There may be some dips here and there, but I think my prediction will be people will plant flags that labor inflation is down, we've corrected it, and that's not true. And it will rear up at least several times throughout the next decade. As companies, we need to think about that in how we go forward. And you're going to see it play out in structural, as we think about from an economic standpoint, and I think about the rise of digital brokers and other people who are really armed to play in the imbalances that are created in supply and demand. The labor nuances are going to factor into that dramatically, which kind of give them a leg up in their ability to create a market that didn't exist 5-10 years ago. We'll talk a little bit more about that. So with the entry of next generation digital brokers, coupled with the power-only business model, what you're starting to see is the leading edge of a different way of doing business. That's still at a relatively fledgling level, but it has a promise to aggregate this ridiculously fragmented truck body and specifically trailer market in terms of carrier demographics. It can do it in a way that is highly capital efficient and takes advantage of a growing set of barriers that have been structurally embedded over the last 10 years that small and medium-sized carriers have a difficult time participating in. The secondary issue is that because inefficiency has grown so much through the logistics market, what we don't talk about, what the carriers don't want to talk about openly yet, there's a few of them, is that they're having to use assets in different ways to bridge this, and it makes some carriers unable to meet the market demands of the future. So let's put that in very granular terms. So instead of talking, I've been doing this for 20 years, so I've been beat down for 20 years going through this. And we can talk about the rise of trailer to tractor ratio in the 2003 to 2007 timeframe. Then it got up to 3.8, 3.9. Then it went through, it was in vogue after 09 to say that was inefficient. I've got too much, I'm going to bring it back down. Everyone was talking about I want to bring it to 2.7. That sent waves through the market. Now we had some undulations through that. Now we're sitting today under the cloak of darkness where people are talking about, I think I need to be running 8 to 1. And some of them are. They just don't all tell you that, except for a few that are actually capitalizing on the market. And it's such a structural change because it's starting to take advantage of the imbalances in a way that'll be further exacerbated by carriers leaving the market because they just can't participate. They can't carry a 2-to-1 ratio or a 3-to-1 ratio. They're going to start dropping out. And the likes of Convoy, Freightvana, Uber, Loadsmith are going to take advantage of that over time. It's core to their model. So that's the new customer segment that Jeff alluded to. So as we look at 2023, we're sitting today at a $3.4 billion backlog. As Jeff said, there is always sensitivity about what will happen, but we have aligned with those customers that literally see a different path forward of how they will play this cycle. So while the fundamentals of what happens inside of a recessionary environment may not holistically change, some players will choose to play it differently. And you have to find out who they are and adapt your business model to that if you want to take a real strategic position to do it differently. And we believe we're capitalizing on that. So what is power only? So I think that is a term that some people know extraordinarily well today, and others are completely clueless in terms of what that actually means. Well, power only is a way for brokers to hire carriers that only bring power to the table. One driver, one truck. They don't have the burden of trailers anymore because trailers are provided from an alternate source. They could be provided by the digital broker themselves, but that's a challenge because digital brokers in general, are not fleet managers, right? They're technology companies at their heart, especially the new ones. Or they provide it through a different source, which we can talk about later. Allows both the shipper and the carrier to avoid live loads or unloads because trailers can be positioned now, because there's a pool, to be able to solve for that. Shippers don't wait to incur charges that come along with the detaining of trailers. We begin to structurally affect efficiency. Drop and hook allows shippers to better utilize their dock staff and warehouse space. We generally know that the rate of change of dock space is woefully deficient for the relative levels of freight that we see today. Take out the idea of what will be happening with freight in the next 2 years, look at it on a 10-year time period, and there's an imbalance. So there are structural issues inside of that need to be talked about. I was talking to a customer the other day, and all they wanted to talk about were the number of trailers that have increased over the last 5 years that are literally being mobile warehouses outside of their shipping partners that is structurally impacting their fleet capacity. And so when they look at the next 2 or 3 years to maintain those contracts, they have to add more trailers, in this case, in some case medium duty, to be able to solve that. And that's not going away for that customer in any way, shape, or form. Allows the smallest carriers to participate in drop and hook operations via power-only broker, again, because now the trailers are not the limiting factor. And if you're a digital broker with advanced technology to match data, to take advantage of the economics, the regional and local imbalances that occurs in the market, you want to make sure that that match can be made when trailers can be the structural element that prevents you from having that being capable when the shipper says you've got to bring trailers to the match to make it happen. So but at the same time, they don't want to own the assets. So we're kind of at this inflection point of this could all be done differently. And that's where Wabash is looking. So this is from Convoy, and we think this echoes the conversations we've had with many carriers, is that with the data that's being talked about, and this is core to their model, and very similar to Uber's and others, is that 35% of the trucks on the road are driving empty. That's shocking. Unless you really talk to them and you go, it feels about right, based on what we hear. That are literally empty in what they do. And I'm going to give you this fact, and we're going to come back to this fact in a minute. Just on tractors alone, if you solve 1%, take out and go from 35 to 34%, you take out roughly 40,000 trucks from the market and almost 250 million gallons of fuel. Just if you can solve 1 or 100 basis points of improvement in that number. We'll come back to that because that's a pretty hard ROI, or a pretty good ROI with sustainability connotations that you can make. You can make a business out of that if you can solve that problem. Okay? So as we think about this, this rising inefficiency isn't just in the Class 8, but it actually flows all the way to Class 3. Most of the disruption that we talk about is right now at the Class 8 level, but there are others, Class 8 dry van or dry freight, being talked about on the refrigerated side. Some are working on the platform side. And there's growing discussions about how this can be tackled in the medium-duty regional transfer space. All brewing kind of under the water level of change that's coming forth. Why is that coming forth? You got to go back to the structural issues that we talked about on the previous slide that aren't going away, that were 10 years in the making and will take another 10 to 15 years to play out. But the scale is tremendous. So unless, here's a statement that's going to carry forward with the entire discussion, unless logistics in general, the broad logistics, transportation, and distribution solves for improved truck utilization, the economics of higher-priced EVs continues to be will continue to structurally constrain the adoption. The ROI just won't be there, and it deteriorates as inefficiency grows. And that's a key aspect of it. This is not we took a bunch of inefficiency and stuck it in the market, and here's what it is. No. These structural issues are growing in intensity as things like nearshoring continues to expand. Labor continues to be an issue. E-commerce continues to grow. All those things will make the efficiency grow inside of the overall market that has to be solved for, which gives new market entrants with a new way a growing opportunity to disrupt. So potential solutions on the rise are that power-only logistics model. We're seeing it not only by new entrants, but you're also seeing it by some of the stalwarts within the industry. J.B. Hunt, Knight-Swift are going to take a similar crack at the issue, just solving it in a slightly different way, right? Coming at it from a different basis of strength, which is they know how to manage fleets. Others are going to come about it with very dynamic, high-end analytical software approaches that can maybe change the literal economics of the market. Increased trailer-to-tractor ratios are, I think, are not taken into account in the forward-looking models to the degree at which it will proliferate over the next 5 years. And I think it will be slow to be adopted. It'll be a wait and see. But from a Wabash perspective, we're not going to wait and see in how we look at it. And then from a Wabash perspective, we have a new offering that's kind of at the fundamental basis level of adoption, which is trailers as a service. So think about trailers not being that, buy one, sell one activity, but now think about Wabash providing an agile service of giving you capacity. All we give you is capacity. It just happens to be in the form of a trailer that allows you to have a more fungible use and dynamic access to fit your business needs over time. That also solves the problem of how you maintain it, how you inspect it, how you create parts and service and overall operational readiness to meet your business needs. That's a different way of tackling this for this emerging market. So for this part of the presentation, what I would take away from it is we're in the most dynamic period of change in logistics within our lifetime. And I don't back away from that statement. I think it's underappreciated for how technology is moving into this space and how is overall affecting logistics models in boardrooms, in strategy offices, within our shippers and carriers right now. The resetting of the global stage that we've already somewhat talked about is real and is pervasive. That will change supply chain strategies in very dynamic ways. I think about Wabash. Arguably at Wabash, we had 20% of our overall supply chain coming from Asian-related countries 4 years ago. It's now arguably less than 4% and shrinking every day. Why? Because we don't want to be exposed to that level of choppiness and disruption. It's one of the reasons we've outperformed the rest in 21 and 22. And we'll do that going forward. Rise of digital technology. I know it's cliche to say rise in digital technology, but it's true, and it's so much more powerful and pervasive than what's casually thought of. The accelerating pace of logistics, model structural inefficiency is an underappreciated aspect of all the econometric models that are out there, and that's a source of improvement as we go forward. And the global focus on sustainability is something, when we think about the global force of sustainability to change the course of climate change, we at times get into a myopic view of how to solve it. But it is undeniable that those forces exist. So you can argue the elements of it and still totally support the overall thesis that that is a force of change that is not going away. Right? Now it's just how best to tackle it and what is the pragmatic realism of how best to do it. Okay? And so that's where we go next. Because if you're going to be visionary, you have to accelerate change that is best positioned for the future. Not what's best for today or tomorrow or for the short-term story. You actually have to be able to say, it's going to happen differently. We're changing our strategy as a result. We're sticking to it. We absolutely know why, because the rest of the world doesn't see it. Right? And so that's kind of where Wabash sits in the world. And with that, so let's talk about decarbonization. First off, decarbonization is a much more complex issue than just, let me flip out my ICE engines to EV power. That's a pretty minuscule argument or way of thinking about it. When we think about full system decarbonization, so let me give you, right or wrong, I'm an environmental engineer. I have a little bit of background on this. Okay? That's where kind of the pragmatic realism comes from. When you think about the full decarbonization cycle, and you have to understand that if you're truly going to affect the rate of change relative to the climate, you have to actually eliminate or sequester forms of carbon dioxide. You can't do that when the majority of our fossil fuels will still be created by fossil fuel sources in 2050. And now we have relative charts that are out there, and some are very aggressive relative to the amount of renewables that will come to bear in the next 30 years. But I'm a pragmatic realist, and those are as much marketing as they are reality. Right? And so when you factor that in, you have to be sitting on a board as you make these decisions to deploy capital. Why am I doing it? Because if I can't get an ROI on the vehicle itself, and the proposition of truly being able to impact the climate may be limited, what's my best fiduciary decision on how I deploy assets inside my company? And I think you're going to see companies come to terms with that over the next 3, 4, 5 years, because they have to. They just have to. So, when we think about what's happening, not only do you have to take out fossil fuels, you have to address the power grids, the supply chains, the ability of sequestering to get to a neutral economy. It is not just as simple as saying, I've got great EV technology on a tractor in any way, shape, or form. You have to look at the big picture. We know that the estimated global range of cost to fix that problem is $20 to $50 trillion. Trillion dollars. Now, we think about all the change that can occur geopolitical and everything else, can they stick with it to deploy that in time to make the changes in the full system to allow this emerging technology to carry forward? I would question there's more no than there is yes in that equation. To put it in US terms, it's $50,000 per household. That's an approximate. A 50% increase in steel is the lowest estimate I could find as to what this means when you go into the supply chain. A 50%, are you all ready for a 50% increase in steel in your products? 4 to 8 trillion is just to support the power grid in the US, ready for utility rates to go up, and a 100% increase in concrete. So it is one of the most carbon used commodities out there in terms of its generation. So when we think about the problems to solve, we think about it from an industry perspective. We put it in a Wabash perspective, because you still have to think about how do you deploy scarce resources for this entire complex situation we find ourselves in. How do you reduce reliance on fossil fuels, create real value, increase levels of service, lower transportation costs for your customers, deal with the regulatory actors, and yet still positively impact the world? That seems like a simple equation to figure out. I'm a pragmatic realist. That's not fun, right? In terms of figuring out how you do that. So what are we not doing? For us, it's not going down an EV truck chassis startup in any way, shape, or form. Well, why? We'll show you fragmented technology needs, excessive upfront R&D, high technology vitality is required to retain market relevance. You just can't come to the market and say, I'm here, because you're out of date about 6 months later. And then lastly, what are the real political, regulatory, and social-driven adoption landscapes that we're going to see just in the US, let alone globally? Very uncertain. So we know that today, from an EV technology standpoint, that we're typically looking at 2 to 4 times the cost relative to an ICE engine. Coupled with what we said earlier, which was growing inefficiency within logistics. And every time it's harder for a truck to deliver a load, it makes the ROI tougher to pull this through. And then if you put the caveat of, I'm really not in the near term or even midterm making a true dent in the sustainability quotient of this, why am I doing it? I think it begs the question. I like this because I think this is what's going around. I know this is going around in boardrooms because we're told by our customers and we experience it in our sustainability conversations with our board. This is from Climate Tech News. So-called net zero pledges. We've seen them for 2 years. 2030, 2050, this, whatever. They must thoroughly review their pledges and align them with this new guidance. Let's tell it like it is. Using bogus net zero pledges to cover up massive fossil fuel expansion is reprehensible. It's rank deception. What they're really saying when you read the rest of it is that you got people going out saying, I'm 2030, I'm 2050, but they inherently know that their actual fossil fuel usage will go up during that time. They're going to try to do it with credits and other types of things, but that is not truly the intent of what the activist aspect of sustainability is looking for. And that's going to be a quandary for boardrooms and executives, especially for publicly traded companies in the future. So when we think about where we're really at, from an EV technology standpoint, our timing to adoption is constrained by clean power generation, capacity, and cost. And you can add charging infrastructure in that as well. The technology fit, in terms of who's bringing what to market with what technology, does not universally fit from first to final mile. Wabash is unique relative to our competitors because we literally look at first mile to final mile and the needs of customers across that entire spectrum to solve their problem, not part of their problem. Totally different. So our view is different. So let's talk about that for a second. So what we did is we took a list of all the basic, I don't say all, but a good list of players. This is like the United States in like 1920 automobile industry, right? Before it got consolidated to 4 or 5. That's how we got to think about it. The massive consolidation is going to occur. Why? Because nobody actually meets the market. They meet parts of the market in limited capability, which lies one of the problems. Who do you scale with here? You have to bring in 4 of them, 5 of them, if you're first to final, maybe more. And do you want to do that? So the supply chain is not really capable of scaling, in my mind. Okay? Doesn't mean you can't prototype and tool around with it, but it doesn't mean you can scale it as we sit here today. So what is the evolutionary curve or disruption curve of this, and factor that into your adoption of EV going forward? Public-private investment in infrastructure is underway, but it's dawning in scale. We just said it's $20 to $50 trillion to pull this off globally. Who's going to bear the brunt of that? US, China, and India. Those are the 3 that have to bear the brunt of it, if you want to make a dent in true decarbonization of the planet. So what this is trying to show is just the electrical infrastructure for light automobile and heavy Class 8 charging infrastructure. When you look at what people think about is this is the amount of electricity consumption based off of a model of converting from ICE to EV. It's just a model, right, with a relatively, let's just say, healthy adoption curve. And what it's saying is that you have a natural growth in energy needs just with the growth of GDP in the base economy, let alone the conversion that will take place with electricity in already a woefully inefficient and incapable electrical infrastructure to be able to do it. Pragmatic realist. Is it possible with everything else we got going on in the world? What's that do to the adoption curves accordingly? I think we have to factor that in. That is from the Department of Energy. And I would argue today they are more generous in their extrapolations and predictions than maybe what's real. Okay? Because they have a story to tell. Lastly, infrastructure without clean power generation yields no real environmental impact and serious ROI questions. Now, that's a pretty strong statement. You don't have to believe it or not. I'm just challenging, could it be true? And if it's true, then what are the choices we make along this pathway? And are they different? Still needing, this is in no way, shape, or form saying that we shouldn't go after decarbonization as a country and as an overall global population. So what's the right way? Short, medium, and long. Okay? This is from the IEA again. Fossil fuels are pressured now and well into 2050 based off of IEA's most aggressive U.S. renewable energy growth projections, if accurate or feasible. That's their statement. I think that's pretty powerful, but it doesn't get headlines. Okay, so where do we think we can go now? Well, again, if we have creeping inefficiency in the overall transportation logistics set of markets, can we, as a group, think about, yes, we need to think about how we bring alternative energy to the world in transportation, but at the same time, we better solve how to get higher asset utilization that creates freight efficiency and reduces emissions. I would argue that is the highest ROI method to go about it today. There are technologies and other alternative energies, regenerative power, autonomous and connectivity, that can aid in that ability to create higher freight efficiencies. And I think there's a nexus there in the near and medium term that people in this audience, as well as Wabash, can exacerbate to grow net sustainable impact with a higher level of ROI now. Okay? So one of the things that I look at, and I'm pulling this from my past, is that we tend to think about decarbonization in this model either in isolate or engineer, which is sequestration, or substitute by moving into an alternative energy. When you tackle efficiency, you eliminate. You eliminate the literal need to burn fuel to run power. And when I do that, I get a wonderful combination of more freight, fewer trucks, holy grail of ROI meets sustainability. Because I literally reduce the need for fuel in what I do. The most one-for-one thing that could happen in terms of input in, output out. More freight with same trucks, cleaner supply chain. Same freight with fewer trucks, cleaner supply chain. You get the idea. And when we can drop this number down, we open the door for increased adoption of those alternative fuel sources, EV, hydrogen, so on and so forth. So I think for our industry, we should be thinking about it in that mindset. So finishing up before we take questions, here's what we're saying. We're bridging reality here. We're in the most dynamic period of change within logistics within our lifetime, as a general statement. The rise of alternative energy, specifically electric, will occur. Nothing that I say here says it's not going to occur. However, the rate of change is constrained and the near-term economics uncertain and pressured. That has to be solved for. Okay? Bringing the engine to life doesn't solve that. Right? So until you look at it holistically, you allow those constraints to be maintained. 3, the world of logistics needs vision and innovation beyond substitution of their sources of energy today. I can make an argument that a digital brokerage running data in a way to dramatically improve the efficiency of the flow of logistics, or shippers that modify the structural capacity and the way that they move their goods and services, can have as much or more impact on the net sustainability in the next 15 years than what we would do with alternative energy. That's my thesis. That we'll see if that bears out. I'll see if my Kung Fu Panda will work with me on that one to figure it out. And then lastly, the chasm can be solved through new asset models, new logistics models, use of data, and power harvesting technologies. And when we broaden the world of decarbonization beyond just what's the rate of change of ICE engine adoption, you're starting to get into a world of realism of what we can actually do as an industry to solve this problem in a financially responsible way with real impact on the environment. So with that, we'll open it up for questions if there are any. If not, we'll turn it back over to Kenny. So questions?
So Brent, you've got me. So you've turned it back over to Kenny. So my question, and hopefully we've got a few more from the audience. It's kind of a near-term and longer-term question on supply chain. So you mentioned at the beginning of your presentation, and first, thank you for a very thought-provoking presentation. But the first one is on kind of ongoing supply chain constraints right now. So if you could maybe talk to those, and when we look at our forecast, through the end of this decade, we've got pretty high forecasts, but we're not like pushing the bounds of industry capacity, and I think 2019 was the all-time high for say the dry van market. Maybe you could talk about expansion in the industry as you look out, and the we see this move to higher trailer to tractor ratios. Thanks.
Yeah, it's a great question. As we look at it and think about it, let's start with the supply chain side of it first. The actual supply chain has really added no additional capacity, fixed plant, property, and equipment in the last 5 to 10 years. So we have no real net change there. the utilization of those assets are dramatically down, structurally encumbered by their extended supply chain and their access to labor. And it's a teeter-totter of what's constraining them at the given moment. You know, their extended supply chain gets a little better, labor is a constraint. They solve for labor, it stresses their extended supply chain, right? To the point of net reduction. Not pause and incremental improvement, like literally net reduction and have to climb back up from it. So it's incredibly still fragile from an extended supply chain standpoint, and I think about it, it takes them half a decade to think about the deployment of capital and the literal moves to shore up their supply chain to make that more resilient. It's one of the reasons we go after long-term agreements right now, because we get the visibility of what that demand is so that we can get that out to suppliers, so that scarce resource is managed in a different way, knowing that reality. And then labor in general. Even if you get the labor through to the extended supply chain, not just in the US, but now Mexico and so on, being able to deploy capital in a truly effective way, knowing you have the labor issues that we have right now, is problematic. So I see real structural reasons why there will not be, and really cannot be, real gains in net capacity over the next couple of years. So I hope that answers your question. Yep. Other questions? Yep.
Yeah, good afternoon, or good morning, I should say. I was recently at a truck manufacturer dealer meeting, and the OE was talking about 2024. We have been on allocation the last couple of years, as I'm sure you would probably say. Your customers have to some level as well as dealers. Mm-hmm. But as you look into 2024, understanding that there's an underserved demand, as you mentioned on the trailer side, and knowing that the supply chain is catching up, which is what's happening a little bit on the heavy-duty truck side of the business, they're saying 2024 could be a year that's not allocation, in advance of what could go back to allocation in 25 and 26 with the pre-buy in advance of 2027 emissions. So I'm just wondering if you could just speak to that allocation side of it, and you certainly have made steps to increase van body capacity at other plants too. So. Thanks.
Yeah, so it really goes off of what Kenny had already asked. So we take that supply chain labor reality and kind of plan it as a fact that you can build off of. I think regardless of what unintended event could possibly occur in 24, I think the industry, specifically truck body and trailer, is looking at a level of allocation between now and 2026. Because I think that demand, now you can argue demand may go up and down relative to what happens on a macroeconomic base. I think from our standpoint, we don't believe the demand models that are out today accurately reflect the actual total demand when you take into account the rise in tractor-trailer ratio, orders because of allocation and other things. It's demand that's never seen, right? Because it's stopped. It literally is constrained at the allocation level. And we don't have a great way of modeling the rise of trailer pools. So I think you could arguably say that there is 20 to, depends on the year, 20 to 30 to 40,000 just Class 8 dry vans that are not taken into account in demand. You throw that on top of everything else we talked about, I think we're living in a world of relative allocation for an extended period of time. Okay. Other questions? Yes, sir.
Hi.
Sorry to make you run. First of all, that was amazing. Terrific. I love the perspective. So I'm just going to ask a question that might be outside your wheelhouse a little bit. Given some of the constraints on decarbonization you were talking about, a large energy company with a lot of pragmatic engineers, British Petroleum, recently bought about 270 truck stops, Travel Centers of America, with the idea that we're going to have alternative fueling platforms and solutions. That would not seem to be a good ROI investment right now, just given some of what you said. So I'm just curious your thoughts on how the industry is kind of positioning itself right now for things that may be much further down the road.
Well, I think we can't really peel back exactly what their strategy is. I think as you think about the deployment of resources over time, in their case, again, not knowing exactly, I think you could argue they're thinking about this in a much more longer-term view than what their short-term ROI is. Now, that'll be something they got to explain to their shareholders over time. But I think you could absolutely fathom them trying today to try to bundle up and get themselves in a position that if some things break loose, they're in an advantageous position. Absolutely. I think it does probably solve and check the box on some short-term sustainability narratives that they can talk about with some odds of harvesting some success off of it. And it's probably a relatively low-risk investment for them, just knowing the general dynamics that's going on. So I don't see it as a bad thing. I think it's a bet, is how I would frame it. I hope that helps. Okay.
I've got one over here.
Thank you for the great insights. So at Uber Freight, as we start ramping up our autonomous pilots, we're adopting this transfer hub model. So how do you see that affecting the long-term trailer demand and the tractor-to-trailer ratio? And then if we're seeing this increase in tractor-to-trailer ratio, like there's a lot of conflicting arguments for sustainability. Like, is that a good thing or a bad thing? So what are your thoughts on that?
Yeah, well, okay, that's a lot. So what I would say is that when we could do a very similar presentation on the rise of autonomous vehicles in terms of the realistic, pragmatic ways of what will or won't prevent that from being able to scale. Okay, so let's take that and park it. If they are able to find the right pathway to be able to scale, the right business model, the right infrastructure, so on and so forth. So one, I think it's a net benefit to the sustainability question. Because to make autonomous work again for the ROI, you have to solve the efficiency problem with utilizing the cost of that asset. Okay, you just got rid of the driver, you limited your hours of service impact, you're going to try to flood that thing with as much uptime as possible, right? So you're going to use trailers to help drive that. And you're going to change your data usage to make sure that that vehicle is put into a model that drives the highest application of freight that it can haul, right? So I think if those two things can be done, then it has the ability of scaling. Now, it has nothing to do with can the technology work, will state policy allow it across the country, will there be a federal mandate to unify that from a transportation infrastructure standpoint? Those are all other types of questions. But I think it's, from my standpoint, it's net positive for our business and our supply chain. I think it's net positive for the environment when it's pulled. And now, you can argue the social impact on what that means to the elimination of real wages to that driver, and what do you do with that driver, but that's not for me to chew on that one right now. Okay? Other questions? Okay, thank you very much. Appreciate it.
Thanks so much.
Yeah.